Hey everybody, thanks for stopping by my channel and I appreciate you being here. And today we're going to do a little primer on APR, annual percentage rate, at least as it applies to mortgages, and try to give you a better understanding of what it is, how we arrive at it, and quite honestly, how flawed, misguided, miscalculated, and inaccurate it truly is. So let's hop on in. So APR, annual percentage rate, it tries to give a customer a fairly good idea of deciding between two different type of loan options, different rates, points, fees, those kinds of things. Today we're going to use a couple of different examples to illustrate the point of APR and where its flaws are. So we're going to look at a loan with 4.25% interest rate and no points, and another loan with 3.75%, paying 2 points to buy the rate down from 4.25 to 3.75. Which is better? Well, let's find out. APR tries to give you an idea of which may be a better option, but its calculations and the way it arrives at APR is a very flawed, very misguided, very inexact example. But let me explain. So for our first example today, we're going to take, well, for both examples actually, we're going to use $100,000 mortgage. The first one's going to have a 4.25% interest rate on a 30-year fixed loan, paying no points. We're going to use lender fees of $800, interim interest of $300. We're going to get into interim interest a bit more coming up. But a $100,000 mortgage at 4.25% on a 30-year fixed rate is going to give you a principal and interest monthly payment of $492. But to really determine APR, what we need to determine is the actual amount financed. So when your loan closes, the lender is going to give you $100,000. But what did you have to pay the lender in order to receive that $100,000? Well, in this scenario, you've got $800 in lender fees, $300 in interim interest, so $1,100. You're going to give the lender to receive that $100,000. So your actual amount financed is $98,900. That's an important figure. So once we've established the $98,900 as an amount financed, we need to establish the APR. And how do we do that? We take your loan, your interest rate, your principal and interest payment, and apply it to $100,000. That's how you arrive at the principal and interest payment. But when we apply that same principal and interest payment to the amount financed, that amount financed is $98,900 with the same monthly payment of $492. We arrive at a rate of 4.35%. That is the APR that they want you to see. Now, if we were to compare that to another loan option, same exact parameters, $100,000 on a 30-year fixed rate mortgage, but in this scenario, you're paying points, you're buying down the interest rate from 4.25 to 3.75, and let's assume the cost of that is 2 points. A point is 1% of your loan amount. So on a $100,000 mortgage, 2 points is $2,000. We're going to keep lender fees the same, interim interest the same, although it would be a few dollars lower because of a lower interest rate. But apples to apples, we're just going to keep it simple and keep it the same. That would result in a monthly payment, principal and interest, of $463. And doing the calculation for amount financed, which we did shortly ago, that would give you an amount financed of $96,900 versus $98,900 because of the additional $2,000 you had to give the lender in points. Now, looking at the APR, on loan 2, the APR is 4.01. On loan 1, the APR is 4.35%. So clearly, that screams that loan 2 is the better option. Hands down, we got to go with loan 2, right? Just makes sense. Not so quick. Let's dive a little deeper. Now, loan 2 may look like a better option because you're buying down the interest rate, you have a lower APR, you have a lower interest rate, but is it really better? It only saves you $29 a month, but it costs you $2,000 more initially in points. So the very simple calculation for determining what we call your break-even point is simply taking the additional cost of $2,000, divide that by the savings of $29 a month, and you have a rough break-even period of about 6 years. It's actually about 5 years, 9 months. That's a generic way of doing it. But we want to look at a more accurate way to determine what we call your break-even point. And so now if you were to take that same $2,000 and rather than pay it in points to buy 3.75%, if you were to leave it on the 4.25% option and simply apply the same $2,000 to the loan amount, you would then reduce your amount financed on that particular loan by $2,000, resulting in a lower principal and interest payment, even though it has a higher interest rate. Now, when we factor that same payment of $492 against that amount financed of $96,900, the savings between the two interest rates is actually only $19 a month. So when we take that same principal and interest payment and apply it to that new amount financed, resulting in only a $19 a month interest rate, $19 a month savings at the lower interest rate. Now your break-even, your true, real break-even time frame becomes about 9 years. Actually about 8 years and 9 months, but we're keeping this simple. So we're going to say 9 years. So loan 2 at the lower interest rate of 3.75 would actually provide you a savings of $19 a month after about 9 years. Even though it has a lower interest rate and a lower APR, it would take you 9 years of saving that $19 a month to recoup the $2,000 it cost you on loan 2 to get it. Now, the chance of you being in that home for 9 or more years, well, that may be relatively possible, but being in that same mortgage for that same period of time is very slim. Most mortgages typically are paid off, refinanced, or the home is sold within a period of 7 to 8, maybe 9 years. So before it even starts saving you money, you probably aren't in that loan anymore. So loan 1 at the higher rate is actually a better option for 9 years before you start receiving any benefit of buying down that interest rate. Now we're going to look at a couple of assumptions that APR takes into account, which here's where the real problem with APR comes in. So APR is assuming you're going to have that initial loan for its entire duration, making only a minimum payment for all 30 years. There's no prepayments, no overpayments, no refinances. You don't sell the home. You're simply going to make the minimum mortgage payment for 30 years. That's quite an assumption. It also assumes that inflation is at 0%. which has never happened and never will. And in fact, you probably have a good idea of what inflation is doing right now to your finances. So APR assumes that inflation is at zero and will remain at zero forever. And it also assumes that the value of your money today is the same value it will have in 20 years from now, or it had 20 years ago. Now we know how absurd that is. What could you buy with $1 20 years ago? A lot more than you can today. What do you think you can buy with $1 20 years from now? A lot less than you can today. So that's a huge, huge flaw. But really, the biggest problem with APR is how it looks at what we call interim interest or prepaid interest. Now, mortgages are paid in what's called arrears, meaning if you make a July 1 payment, that covers the principal and interest for June. If you make a September payment, it covers the principal and interest for August, so on and so on. So it's paid in arrears. Your mortgage payment pays the principal and interest for the prior month. Now, interest on your loan starts accruing the day it is funded. So if you were to fund your loan in the first few days of a month, say around the second or third, you may have 27 or 28 days of prepaid interest. But your first mortgage payment is going to be nearly 60 days away. If you close the loan at the end of the month, you may have 2 or 3 days of prepaid interest, but your first mortgage payment is going to be 32, 33 days away. So the interest is a daily accrual. It's not something that you don't owe. Just like any other loan, you pay interest on a daily basis. So interim interest being included in the APR calculation is completely absurd. It's simply a cost you're going to bear regardless. The loan funds, it starts accruing interest, regardless of the day it funds. So having interim interest included in the APR calculation is a huge, huge flaw. And it also opens it up to some manipulation by some less than ethical lenders. So if one lender were to send you an estimate showing 15 days of interim interest included in the loan, and another lender sends you the same exact option with only 1 day of interest. Same loan, same rate, same amount of money, the only difference being interim interest collected on the loan based on the days left in the month in which the loan funds. The guy with 1 day of interim interest is going to have a lower APR, although that is completely a flawed calculation. And it is the way that many lenders will manipulate that figure to think you're getting a better deal than another lender simply based on changing the amount of days of interim interest collected, which may not be accurate whatsoever. So in summation, APR is really a bad way to compare loans. What you really want to look at is costs versus savings. Are you paying points? Are you not? If you are, what are the savings versus the cost of that savings? You want to take that into consideration, and you also want to consider the value of money. What you spend today, what is it really worth once you reach your break-even point? Is that same money worth that same amount at that point in time? And that, as we all know, is not. Hope that helped, and tune in for some more, hopefully, useful videos.